Okay. So we come to bond markets. Right. Now, what we did last week was essentially on, and the first half of today was essentially on money markets, where we talked about ways that people raise money short term. Short term. It's a place to warehouse short term funds, and it's a place to issue short term instruments and borrow on a short term basis. Now we come to capital markets. Bond markets are one part of capital markets. Here you're raising money for long term, for investment purposes. So where you want to now for working capital purposes, you look at like a CP or something like that. But for investment purposes, where you're looking at building a factory, buying new property, plant, equipment, whatever, for long-term projects, then you're looking at raising money for longer term. And this is where bond markets come to help you. So when governments raise money for long term, we talked about treasury bonds. When corporates raise money for long term, we talk about debentures, for example. You also have securitized paper and a few other instruments, but mainly debentures. So capital markets are typically where your original term to maturity is greater than 1 year. Long-term financing for investment purposes, like bonds, are capital market instruments. And when we talk about bonds, I'm colloquially referring to everything from debentures, trust paper, to treasury bonds, right? As well as stocks. Stocks also fall under capital market instruments. So when you talk about primary issuances or primary issuers of these types of securities, if it's corporations, you see equity and debt issues in the form of debentures. If it's governments, you see debt issues in the form of treasury bonds. So what's important to understand here, bonds are also still a form of debt. When you invest in a bond, whether it is a treasury bond or a debenture or even a securitized paper, when you invest in bonds, you are essentially becoming a creditor of the company. You have rights to get your money back. Unlike shares, in shares, you are an owner of the company. In bonds, you are a creditor to the company. So when you're investing in bonds, what are you doing? The company is taking a long-term loan. And here I'm using bonds interchangeably. Remember that the term bond I'm using for debenture as well. The company or the government is taking a long-term loan, and you are a creditor. As an investor, you are a creditor. So this is what we talk about. So in shares, the cash flows are what? Dividends. In bonds, the cash flows are what? Coupons. We call these cash flows coupons. So in bonds, what do you have? You have these interest payments, right? These interest payments can be quarterly, monthly, semi-annual, annual. But what are they? They are essentially interest payments. And these interest payments in bond terminology are called coupons. And there's a reason for that. So when you look at a typical bond and debenture, a typical bond or debenture has specific features. This is not true for every single debenture, but we'll say plain vanilla debentures. Plain vanilla means without any other features. This is what a typical debenture will look like. This is what a typical treasury bond would look like. What would happen? It would be a long-term instrument with maturity greater than 1 year. And within that maturity period, you would have the instrument will be redeemable, right? And at the end of the period, you get, when it's redeemed, you get your face value back. You get your money back in the form of your capital is called your capital is called your face value. Face value. In between, you get interest payments. And these interest payments are called coupons of a bond. Coupons. So for some of you, you would know all of these in the back of your hand. For some of you all, it will be very new to you, right? So You have your face value and you have your regular coupons. Coupons are what? Interest payments of the bond. So coupons are always calculated based on face value. So if I say your coupon rate or your interest rate is 10%, for example, and your face value is 100, that means you have to get 100 rupees back in your certificate. It says that you are promised to be paid back 100, right? If your face value is 100 and your coupon rate is 10%, then the coupon that you get, if it's an annual coupon, will always be 100 into 10%. If it's a semi-annual coupon, you divide it by 2. If it's a monthly coupon, divide it by 12, and so on, depending on the frequency of the coupon. This seems very straightforward. You'll be like, why am I saying this? But if you remember, in bank loans, when you take bank loans, what happens? Your regular cash flows are essentially you get a part of your capital, your principal back, plus interest, right? If you take a regular bank loan, you may have a fixed repayment, and part of that is your capital, part of that is your interest. Here, no capital is paid back until the end of the period. Only the interest. Right. And there is a difference between the capital, what we call the face value of the instrument. We also call it the par value of the instrument. Face value, par value. These are all interchangeable names. Par value of the instrument is different from today's market, today's price, which can be the market price or the intrinsic value of the instrument, right? It's different. So the price today can be equal to the face value, but does not need to be equal. It could be greater than or less than the face value of the instrument. So the price today can be different to the face value as well. But the coupon is always calculated on the face value, not on the price. You can have zero coupon bonds as well. Zero coupon bonds simply mean that today you issue this bond with the promise of getting back your face value at the end of the period, and you get nothing in between, no interest payments in between. What is this? This is simply a discounted instrument where the price is always less than your face value. And the difference, this capital gain is your return. Of course, the capital gain has to be annualized, and that is your return. So a zero coupon bond doesn't have any cash flows in between. So just a bit of history. Why is this coupon? What is this coupon, right? Why do we call these interest payments coupons and face value and all that, right? Again, remember, those days bonds were scrip instruments, meaning certificates. Now today, bonds are scripless. But those days, bonds were scrip, right? They were certificates. Today, bonds are scripless or digital format. Now, when you look at an old bond, for example, something like this is how an old bond certificate used to look like. In the bond certificate, you can see this is the certificate, right? This whole thing is the certificate, of course, but this is the main part of the certificate. This certificate says this is a treasury bond. In the US, they have what we call treasury bills, treasury notes, and treasury bonds, right? In Sri Lanka, we only have bills and bonds. But in the US, they define treasury bills, treasury bonds, and treasury notes. Notes are like medium-term maturity debt. Same way. So here in Sri Lanka, we don't use the medium-term maturity debt. Anything greater than 1 year is a bond. But for notes like 2 years to 5 years or something, it's defined as a note in the US. So this is a treasury note. Do you see here the certificate? On the face of the certificate, it says that this certificate is worth $1,000. So that's the face value of this certificate. On the face of this certificate, it says that this certificate is worth $1,000. That's how the term face value or par value comes into play, right? So the United States of America is promising you back $1,000. 9% treasury note, issued February 15th, 1979, maturing February 15th, 1987. Right? So this is an 8-year note. So then notes must be 10 years. Okay. This is an 8-year note. Interest payable every August 15th and February 15th. Right? You can see here, interest payable every August 15th and February 15th. Right? August 15th and February 15th. So this entire treasury note was longer than this. It was not just this certificate. It was this entire certificate was much longer than this seal, because they used to have, so if you can see here, you see these little cash flows. Now think about it. This is a 8-year note, right? Paying 2 coupons per year, 2 interest rate, the interest is paid twice per year. Sorry, right? Interest is paid twice per year, right? Or 2 interest payments per year. So how many interest payments in total do you have over the life of the note?
16
interest payments. So 8-year note, 2 interest payments per year, 16 interest payments. And each interest payment is how much?
$45.
Yes, $45, because the face value is 1,000. Interest rate is 9% for the entire year, but interest is paid twice per year. So interest payment is $45 each. So what used to happen was each of these certificates had a tearable, like, those little tearable pieces, which reflected the amount of interest you're supposed to get. So what do you do? Every time you have an interest payment, you tear away this piece of paper. So this is your 13th interest payment. Just like this is started from one first interest payment, second interest payment, so on. This paper only shows you your last 4 interest payments. 13th interest payment, 14th interest payment, 15th and 16th. Last interest payment happening February 15th, 1987. August 15th, 1986. February 15th, 1986, August 15th, 1985, so on. $45. And what people used to do is they would tear away this piece of paper when the interest payment came, take it to the bank. The bank would take that piece of paper and pay you your money. That was like, if you remember, it's used a lot in the US and countries like that. We don't see it a lot in Sri Lanka anymore. But if you remember, sometimes you have in the papers, these tearable pieces of paper, they say you tear this piece of paper and present it at the shop, and they'll give you a discount. To get a discount, you tear this coupon, present it at the shop, and you get a discount. Right? These tearable pieces of paper are called coupons. Right? So you take your coupons to the shop, to Kiehl's or Cargill's or whatever, and then you can get discounts on whatever you're buying, right? So they are coupons. So just like that, these are coupons. You have these tearable pieces of coupons that were there, and you tear those coupons out of the certificate, take it to the bank, and you get your money. And that's how that term coupon comes into play. That's why we don't call it interest, we call it coupons. My coupon is $45. So that's how the term, so that's why in bond terminology, we don't use the term interest. We use the term coupon. We have a coupon rate. We have a coupon amount. Okay. Any questions? Okay. So let's talk a little bit about bond characteristics. So what we're going to do is, this is a little bit of a longer section on all on different, like new innovations in bonds and the bond market in Sri Lanka and so on. Next week, we're going to jump this section and go on to bond valuations, right? Because we have a on-site class. So on-site class, it's easier to start off your valuations on-site. So next week we'll do bond valuations. After what we do today, I'm going to pause this for a minute, this section, and concentrate on valuations, and then come back to this section again, this set of slides again. Other than the last set of slides, bond markets in Sri Lanka, you will need that for next week as well. Because it's on-site class, it's easier to do that initial basics, right? So then you have that basics with you. So we'll do the valuations while on the on-site class, and then come back to this. So when we talk about bond characteristics, right, this is again for both treasury bonds and for debentures. There are certain things that we will talk about. Like, for example, a bond will have a maturity, a coupon. Some bonds will have security, guarantees, subordination, callability, putability, convertibility, right? Every single characteristic will not be there. Every single characteristic will be there for maturity and coupon rate. Every bond will have, or 99.9% bonds, right, will have maturity and coupon. It will be defined. What is maturity and what is coupon? This is common to treasury bonds as well as debentures. Security, guarantee, subordination, callability, putability, all of these features are mainly for corporate debt debentures, right? Or for corporate debt or debentures. So things that how we will talk about this section is to look at mostly how, as an investor, when you're investing in a corporate debt like debentures or in treasury bonds for the first two parts, what are the things that you have to consider as an investor? So, maturity. Now, remember, we talked about this last week as well. When we talk about maturity, you have two types that we define. We talk about term to maturity, and we talk about original term to maturity. What is the difference between these two? Term to maturity and original term to maturity.
Term to maturity is more from whatever midpoint, but original is from issuance.
From the time it is issued, yes. Original term to maturity is the time it takes for the bond to mature from the time it was issued, right? At the time it was issued in 2021, it is a 5-year bond. That means it matures in 2027, right? 2021, 5-year bond, 2026, right? So today, is it a 5-year bond? Today is 2024. Is it a 5-year bond now? It is no longer a 5-year bond. Why? Remaining maturity is from 2024 to 2026. It is a 2-year bond. So original term to maturity of my example was 5 years. Original term to maturity was 5 years. From 2021 to 2026, it was a 5-year bond. Now the same bond today, all of this time has passed. The term to maturity of this bond is a 2, right? It is now a 2-year bond, not a 5-year bond. So what is more relevant, term to maturity or original term to maturity? Term to maturity or original term to maturity?
Term to maturity.
Yes. What we care about is term to maturity. Remember, you all made this mistake, or some of you always make this mistake, right? You think about it from the time that it was issued. We don't care. When it was issued, it might have been a 5-year bond, 10-year bond, whatever. We don't care. We care about today, how many years more to go, or how much more time to go till it matures. So term to maturity or the maturity period is most important factor when we determine whether to buy a bond or not. We don't, for example, when I'm deciding today, should I buy a 2-year bond, 5-year bond, or 10-year bond? I'm not thinking about a 5-year bond that was issued in 2021. Today it is a 2-year bond, right? So I don't care about when it was issued. You can have bonds that don't have any maturity. These bonds are called perpetual bonds. Now, recently, since January, 24th of January or so, very recently, the stock exchange has introduced perpetual bonds to the ability to list and trade perpetual bonds as well. Right? So now you can have bonds in our stock market, debenture market, which are perpetual, which don't have any maturity date. It will only keep giving coupons. There won't be any face value that you will get back because the bonds are forever. But perpetual bonds are not very common. They are there. And now they can be there in Sri Lanka as well. But mostly you will see that all bonds will have a redemption date. Obviously, you understand, longer the tenor of the bond, higher the risk to you. So therefore, longer tenor bonds should technically offer higher rates than shorter tenor bonds. They have to offer you higher yields than shorter tenor bonds. So today, your 3-month bills will be at 9 odd, right? Your 1-year bills will be, say, just below or 10. But when you go along the yield curve, right, your 5 years will be at 12, your 10 years will be at high 12s, like 12.80 on year 13, right? Why? Longer tenors should be offering you higher yields because of uncertainty. There can be situations like we had in Sri Lanka over the last year, where longer tenor bonds were offering lower yields, comparatively lower yields than shorter tenor bonds. But that is a anomaly. That's not something that you see all the time. Especially for Sri Lanka last year, we were going through a crisis, and a lot of those impacts have been adjusted now. So, as an investor, what are the things that we have to think about when we are buying bonds? Only for maturity, not about everything else, right? When I'm thinking about buying a bond and about maturity of the bond, would you as an investor prefer to buy a 2-year bond, 5-year bond, or a 10-year bond today? There's no right or wrong answer. Only I would just want to know what are your considerations. You might have a preference. Why is that?
Based on your risk appetite
Okay.
and the return.
Based on your risk appetite and the return, correct. But so you're completely correct. But according to your risk appetite, if we look at a normalized situation, longer tenor bonds will offer you higher returns to compensate for your risk.
Yes.
So then what else would be other considerations?
Liquidity requirement.
Okay, liquidity requirement as long if the bonds are illiquid, especially as you go along, 2-year bonds will probably be more liquid than the 5-year bonds or the 10-year bonds. Yes. What else?
When do you need cash for
Yes.
maturity of the bond? Cash from maturity?
Yes. When do you need cash on the bond? So that's kind of like the liquidity requirement as well, but it is an argument to say bonds can be more illiquid than shorter term instruments, right? More. Not that like treasury bonds will be very liquid, but if you look at debentures will be very liquid. And longer term debentures will be more illiquid than shorter term debentures. Even in treasury bonds, 10-year bonds will be more illiquid than, or less liquid than your shorter tenor 2-year, 5-year bonds, right? So if that is the case, you should be looking at when would you need your cash? Can you afford to have your money stuck for the next 10 years in a debenture, for example? If you need your cash within the next 2 years, then you should probably be investing in the 2 years. So maturity of your liabilities or your cash flow needs play a part. Future interest rates play a part. Today, as we stand here, would you rather invest in a 2-year bond, 5-year bond, or a 10-year bond? Thinking about interest rates. Again, no right or wrong answer, only opinions, right? But 5-year bond, why do you say that? Okay. So you would want to invest in a longer tenor bond versus a shorter tenor bond because interest rates are coming down. Right. So yeah. So if you think interest rates are coming down on a falling interest rate environment, I would want to fix my rates. So I would invest longer tenor. If interest rates are going up on increasing interest rate environment, right? I don't want to fix my rates. I want to keep my maturities as short as possible so that I can reinvest that later on at higher rates, right? So if interest rates are expected, if you expect interest rates to go up, you would keep your tenors short. If you expect interest rates to come down, you would invest in longer term bonds. Then we have what we call this tolerance for interest rate risk. Tolerance for interest rate risk. What is interest rate risk? It is the risk of interest rates going up. It is the risk of interest rates going up. So we know that, I have said this many, many times, interest rates and the value of bonds are inversely related. Interest rates and the value of bonds are inversely related. When interest rates come down, bond values go up. When interest rates go up, bond values come down. Interest rate risk is about the risk of interest rates going up. When interest rates go up, bond values will come down. So the risk is there. Interest rates moving up. And your tolerance for interest rate risk, because when interest rates move up, long-term bonds are more sensitive to interest rate movements than short-term bonds. So if we have the same 2-year bond, 5-year bond, and the 10-year bond, when interest rates go up, 2-year bond price will come down. 5-year bond price will come down even more. 10-year bond price will come down even more. Right? Same way the other way around. When interest rates come down, 2-year prices will go up. 5-year prices will go up. And 10-year prices will go up. But 10 years will go up much more than 2 years. So the longer tenor bonds are much more sensitive to interest rate movements than shorter tenor bonds. So we say longer tenor bonds have higher interest rate risk than shorter tenor bonds. So this is only relevant if you hold these bonds until it matures. If you don't hold these bonds until it matures, right? You don't hold the bonds until they mature and you start to trade on it. Then what you see is trading means like shares. You're buying and you're selling, right? And if you're a trader, what you see is when interest rates go up, bond prices are coming down. What is your tolerance for interest rate risk? Because when interest rates are going up, I would keep it very short term. But I can be wrong. I can have the view that interest rates are going to come down, but my view can be wrong. That's the risk. So if my view is wrong, how much money can I afford to lose? That's what I mean by tolerance for interest rate risk. Most of the time, traders will buy bonds when they think interest rates are coming down, and longer tenor bonds when they think interest rates are coming down. Because longer the tenor, higher the profits that they will make. Risk is what? What if they're wrong? What if the rates move up? Then they make losses. How much of those losses can you tolerate? That's what we call your tolerance for interest rate risk. So longer tenor bonds have higher interest rate risk than shorter tenor bonds. Any questions? Okay. Coupon. So we talked about what coupon means, right? And it's the annual interest as a percentage of the face value or the principal value or the par value of the bond. It is the annual interest. Coupon rate is the annual interest rate as a percentage of the par value or face value of the bond. We also call this the nominal yield. When we come to the yield section, you see that We also call this the nominal yield of a bond. Now, in bonds, there is a difference between coupon and yield. Any idea what that means? There is a difference between coupon and yield.
Coupon is based on the face value, whereas yield is based on the investment value.
Coupon is based on the face value. Yes. Yield is what? Yield is the total return based on investment value as well. Yes. So coupon is the return that you will get if you purchase the bond at face value. Okay. Or essentially it is the interest rate that you will get. But when you have a bond, remember what's the return of a bond? It's still the capital gain plus your cash flows. What are your cash flows? Your cash flows are your coupons now. Technically, as a percentage of your initial investment. So with bonds, it's a little bit more complicated than this simple equation because bonds are long term. So these have to be annualized, compounded, all of that has to be taken into account, right? But in simple terms, this is your return, capital gain plus coupon as a percentage of your initial investment. So in your bond, you have these coupons that you get. And you have a face value at the end of the period. Today, you pay a certain sum. The difference between the sum you pay today and the face value is your capital gain or loss. Because this sum can be equal to your face value, it can be less than your face value, or it can be higher than your face value. Right? So it can be at par. We call it being at par. Being at a discount to your face value, or being at a premium to your face value. Okay. So you can make a positive or negative capital gain, a capital gain or a capital loss, which will of course be negated by the fact that you also get a coupon over this period. The total return, your capital gain or loss plus coupon, that total return is what we call yield, the yield of the bond. Of course, we call this yield to maturity. The equation is a little bit more complicated than this, but this is the basic. This is the basic, right? That's the yield. Versus the coupon is the return. If, for example, you didn't buy this bond at a discount or a premium, right? If you purchase this bond at par means what? At the same value as the face value. Then what is your return? There is no capital gain. Today you buy this bond at 100 and you get at maturity 100. So no capital gain. Then what is your return? It's only the return from your coupon. And that is the coupon return, or what we call the nominal yield of the bond. So there is a difference. When we talk about bonds, what is more correct? It is to evaluate it is to evaluate your yield or yield to maturity. Okay. It is the more correct method, not to look at your coupons. A lot of the time, people who are not familiar with bonds, they will look at the coupons and say, I'm getting a 20% return from this bond. There's a coupon rate of the bond is 20%. But no, you're not getting a 20% return from that bond. If you're paying 120 rupees to buy that bond, even though the bond is paying you coupons at 20%, at the end of the period, you're only getting 100 back. Today, you're paying 120. So your total return, your yield is lower than 20%. Yeah. So although we talk about coupon rate is the rate that's given by the issuer. That's paid to you by the issuer because it is the interest rate. Yield is more applicable to us when we're trading in the secondary market. Any questions? Okay. So when we talk about coupons, you can have fixed coupons, you can have floating rate coupons, and you can have zero coupons. A lot of bonds are fixed coupon. Government bonds are all fixed coupon bonds. Right? Meaning, if you say coupon rate is 10%, it's 10%. Floating rate coupon bonds are essentially bonds that change with interest rates. So usually floating rate coupon bonds, you will see something like, for example, like what we're talking about, LIBOR plus 3. That's a floating rate coupon bond. That's for the US dollar denominated bond. In Sri Lanka, you might have treasury bill rate plus 2. So your coupon rate is based on the treasury bill rate that is prevailing. Usually the treasury bill rate prevailing at the beginning of the period. Treasury bill rate prevailing at the beginning of the period. So that's what we call, this is what we call the reference rate, okay, or the benchmark rate. And this is the premium to the benchmark. Premium to the benchmark. So for example, you know that a company is issuing this bond, right? The company can't be issuing a bond, a floating rate bond at a coupon rate of treasury bills. A company is not a government. A government can print money, now not as much as before, but a government can print money and pay back in case of worse situations, right? Companies can't do that. So therefore, companies can't get coupons at treasury bill rates. They have to pay something additional for the fact that they can default. This is the premium. Right? So companies with lower default risk or high credit quality will have lower premiums versus companies with a higher default risk will have higher premiums. Yeah. So before we come to investor considerations, before we come to this, let's do a quick calculation. Very easy, very quick. Try this.
I'll see the last row of the table.
You don't see it? This row, is it? 31/12/2024, 10.8. So you have 12.93, 9.7%, 8.5%, 10.5%, 10.8%.
Madam, aren't we supposed to have the face value of the debenture here?
Yes. So for all our calculations going forward, if nothing is given, you use face value of 100, right?
100.
Because there's because there's a lot of calculations. Sometimes I just don't put the face value. If it's not there, use 100.
Okay, thanks.
Miss, what does this reset at the beginning of the period mean?
So the coupon rate changes at the beginning of the period. The new rate is effective from the beginning of the coupon payment period.
Right.
So, Janni, you're correct. Only thing is, which one is not relevant? Because if the T-bill rates at the end of each quarter is this, what are the coupons paid in each quarter? 2024. So on 31st of March 24, that's why this is 0. March 24, June, September, and December. So you put 5. Only 4 are relevant. Which 4? Uh, 3112 is not correct. Those Yuvanka, others are correct. Yeah. So here it's a very simple question, right? Very small, very simple question. Debenture pays coupons each calendar quarter. Calendar quarter is essentially what that means is end of each quarter as per the calendar year. So 31, 3, 36, 39, 31, 12, right? Each calendar quarter based on the 3-month treasury bill rate plus 3%. So usually that's also market practice. It's not that you have, it's a hard and fast rule. No, you don't have to stick to it. But usually you see if quarterly coupon payments are made, then it's based on the 3-month treasury bill rate. Semi-annual coupons are based on the 6-month treasury bill rate, and the annual coupons are based on the 12-month treasury bill rate. Right? That's just market practice, right? It's not that you can't change it. It's up to you. So this is your benchmark. That's the benchmark. This is your premium. And the benchmark changes because the benchmark is what changes, no premium doesn't change. The benchmark changes at the beginning of each period. So what happens is, Anuradha, again, you're correct. Only thing is, you have shown 5 coupons. I want to know the 4 relevant ones. Which 4 are relevant? Nimasha, correct. So let's say, for example, 31/3, 31st of March. What is the treasury bill rate prevailing on 31st of March according to by like estimates that have been given, right? Not forecasts, estimates that have been given in this question. 9.7, right? That's the treasury bill rate that will prevail, and the treasury bill rate, actual treasury bill rate that prevailed on 31st of December was 12.93. Now, based on what rate will the company pay me on 31st of March? Based on what benchmark rate? 12.93 or 9.7? Based on 9.7. So on 31st of March, am I going to be based on 9.7? Johan, correct. Is that right? 9.7?
12.93, yeah.
12.93, right. So yes, actually it's not 9.7, it's 12.93. Why? Although I'm being paid on 31st of March, right? And the rate prevailing on 31st of March is 9.7. That rate will be applicable for the next quarter. This will be the rate that will be applicable for the payment next quarter. But the payment that will be made to me on 31st of March is based on the rate prevailing at the beginning of the last quarter. Or beginning of this quarter, end of last quarter. Right? So the rate applicable is set at the beginning of the quarter and reset again at the beginning of the next quarter and reset again at the beginning of the next quarter, right? So for 31/3, the rate applicable to me, the benchmark rate is 12.93. This is also because for accounting purposes, it makes it easy, right? So the usual market practice, it's not that you can't. Again, I'm saying it's not that you can't set it at the end of the quarter. But then it becomes a little bit more difficult for accounting, right? Because in accounting, you would in your ledgers and all that, you would accrue at a certain rate. Now, until the end of the quarter, I don't know what rate I'm accruing at. And here, all interest payments are made on exactly on the calendar quarter, right? Most of the time in debentures, you will see some debentures are issued paying interest every 20th of March, 20th of April, 20th of. So you jump a quarter, you don't know what rate you're accruing at. And you had to submit your accounts and you had to publish your accounts for listed companies. It's a little bit more of a hassle process, right? So there is a bit more of a hassle when you reset it at the end of the period. That's why usual practice is to reset coupons at the beginning. But it is not a hard and fast rule, but usual practice. So you reset coupons at the end of the beginning of the period, then you know what is the next coupon you're going to get. It also makes trading easier because I know what my next coupon is going to be, right? Otherwise, until the end of until 31st of March. Now, today, I am here today. What is today? 24th of February, right? So yesterday, Friday, 23rd, if I wanted to trade this bond and coupons are reset at the end of the period, I don't know at what rate I have to trade this bond, right? So that's a problem. Just give me 1 second, please. Sorry about that. Okay, so after that, once you understand that, it's very easy, right? So 12.93 is what will be paid on 31/3. So what is the coupon rate? 12.93 plus 3, 15.93. Coupon paid at the next period will be 10.7.
$12.7, no?
Sorry, yes, 12.7. My mistake. 12.7. $8.5 plus 3. And 10.5 plus 3. So you see the coupon varies for each quarter. How much is the coupon amount that you will get? 15.93 into 100, right? This gives me the coupon for the year. And then I divide it by 4 to give me the coupon for the quarter. So which comes to, I see 3.9715. Is that correct? And then you all have said 3.1663. 2.8671. 3.4783. Okay. So, things to keep in mind when you're picking, when you're looking at a floating rate debenture, is it reset at the beginning of the period, end of the period? On what rate is the benchmark based? Is the premium that is given to you enough? Right? These are things that you will look for. Also, other things that you will look for when selecting a coupon rate, right? What coupon to select? Let me show. Let me throw an example. Just give me a minute. Okay. So, things to look for, right? One is,
Ma'am,
yes.
excuse me. The previous question, now say
Mhm.
for at the end of 30th June of 2024, so the coupon payment should be again 100 into 100 into 12.70 divided by 4, no?
Okay, yes, that's right.
The rate, the amount.
Is that wrong? Amount is wrong, is it?
Yes.
3.1875, is it?
Yeah.
So she has
yeah.
taken 12.7, ma'am, whereas she has to take, I think, 15.93 because the start of the period rate was 12.93.
For the
No, no,
first
no.
one. This is okay. I think these numbers look wrong, right? Is that the
Yeah,
problem?
Yes,
This is 3.9825.
9825. Yes.
Okay, sorry.
The second one is 3.175. Not mistaken.
13.9825. I'm using your numbers in the sense what you guys have posted. So I don't know who had
3.175.
1875,
Yeah.
2.875, and 3.375. Is that right?
Yes, ma'am. Yes, correct. Now correct.
Okay.
Madam, for purpose, don't
Sorry.
we need to count the days that 365, 91, that kind of exact days for the quarter?
Yeah.
Or
So for
this-
corporate debt, no, you're right to the extent. So for corporate debt, right, there is this anomaly that happens. Now, when you value debt, what we use is just you simply look at what is the value divided by 4, right? If it's quarterly, you divide by 4. If it's semi-annual, you divide it by 2. So the valuation that you put in your trade screens, the brokers that will enter on your trade screens will essentially be based on, for example, these values, right? Like exact payments, equal payments happening. And this is true for government debt. Government debt, always that's the case. Always it's a fixed coupon. Like you saw in my earlier example also here also, it's a fixed coupon. It doesn't depend on whether it's 183 days and 182 days the next period or anything like that. Every period you get this fixed coupon. But corporate debt, debentures, right? You're right. Actual coupon paid by the company secretaries or the registrars does depend on the number of days. But for calculation purposes, it's simply for calculation purposes, meaning for valuation purposes, it's simply you're looking at the coupon amount for the quarter is that coupon, whatever the rate into the 100 divided by 4. If it's quarterly, if it's semi-annual, it's divided by 2. It's equal coupon amounts for valuation purposes. That's how it's taken. So there is a bit of an anomaly in debentures that are happening at the moment. So you're right there. For our calculation purposes, we just use the standard calculation similar to bonds, where we say that it's equated calculations.
Noted, madam. Thank you.
I have a small when it comes to these calculations, like is it possible when there are calculations like to actually give us the correct figure so that in case in most instances I get it wrong, so when I revisit the calculation again so that I can wrap my head around and get to the correct answer.
He's right, no? These are the correct figures.
Yeah, these are correct. These are correct. Going forward also, like if we can get the correct figure, so then when we revisit the
that depends on whether you all give me the correct figure. I can only use what you all give me. That's the problem.
Right. Okay. No, because then if we get it incorrect the first time around,
I understand.
also,
That's a problem.
yes.
So that's
Yes.
there. I completely take your point, but you pointed out, or earlier it was pointed out, somebody should raise their hand and essentially just say that that figure seems wrong. That's all, right? Because others have worked out. Somebody has worked out the figures. So if one person is wrong and a couple of people are right, just one person needs to come out and say, "Isn't this wrong?" And then it will get corrected. So it's about participation.
Yeah, right. The first, what I'm saying is if we get it, if we don't reach the correct answer, and if we are to try and get the correct answer on a later stage, we won't have any figure to check and verify. That's what my concern is.
Agree. No, but that happens usually in a classroom environment. Somebody will put it up and say that this is correct. This is not correct. Right? So that depends on your participation, but usually that would happen.
Okay, man. Thanks.
So, your considerations in selecting a coupon rate, right? For example, your interest rate expectations. What type of coupon rate would you select? Would you rather have a floating rate coupon debenture today or a fixed rate coupon debenture? Floating or fixed? Today, like I said, like we did for maturity, there's no right or wrong answer. It's your thinking. For a certain company, given that they're giving you the correct premiums, right? Would you rather have, I can't put numbers because it depends on the company and all that, right? Would you rather have a treasury bill rate +3, or given that treasury bill rates are like, let's say 10% now annual coupon, somewhere there, a fixed rate of 13%? No right or wrong answer, but what is your thinking process?
Fixed.
Because
The rates are
the rates are coming down, so you would want fixed, right? So again, no right or wrong answer, yes. So if you think the rates coming down and they're continuously going to keep on coming down, then you would want a fixed coupon, because floating coupon means the rates will continuously come down and your coupon will keep on coming down with it. Versus if you think rates are coming down, but it's temporary, but it's overall going to go up over the next 5 years, right? Then you would want a floating coupon, right? If you think overall rates are going to go up over the next 5 years, for example, you'll want a floating coupon. So if you think rates are on the uptick, ideally, I'd like a floating coupon bond versus a fixed coupon bond. If the rates are on a downtick, I'd prefer fixed coupon bond. So my interest rate expectations play a part on what type of bond I will choose. My frequency of income requirements. How often do I want my cash flows? Would I prefer to have to invest in a monthly coupon bond, quarterly, semi-annual, annual, or zero coupon bond? These are the options that I've given to you. Which one would you prefer to invest in? Again, no right or wrong answer. Which one would you prefer to invest in?
monthly because
Sorry, say that again. Which one?
monthly
Okay, because
the number of times that will be compounded is higher, so your effective annual rate is likely going to be higher.
okay. So monthly, it's okay. There's no right answer for this. So, but in terms of the thinking process that you said, the number of times that it's going to be compounded is higher. Yes and no. It depends on how they will give this to you, right? Like, let's say, for example, they give you a 12% monthly coupon bond, 12% per annum. That means every month you get 1%. And they give you an annual bond of, let's say, 12.8. .68, right? Your compounding is taken care of here. Monthly 12% is equals to annual 12.68% on a compounded basis. Then what? Okay, definitely that's something that you will think about. Yes. Is your reinvestment, for example, if you think that rates are coming down and you keep on getting coupons monthly, you'll have to keep on reinvesting it at lower and lower rates, right? Versus if you get annual coupons, you get the coupon and then only you will have to reinvest it, right? So you'll get it all this time lower, but like then you'll have to reinvest it. So it depends. There is a positive and a negative of both. Here you have average reinvestment. Here you don't get a lot of cash flows in between to reinvest. So that's something that you think about. Frequency of your income requirements is a bigger thing that you should be thinking about, right? How often do you want these coupons? Monthly, because some people prefer Some people prefer to get it monthly because it's like salaries, right? It's like if you get a monthly coupon, it's like you're getting your salary. Every month you have some amount of cash flows coming in. For the issuing company, it is a little bit more cumbersome, right? So actually in 2013 was a golden year for debentures in Sri Lanka. 2000, they gave these tax concessions for debentures in Sri Lanka around that time in the budget, the 2013 budget. And essentially the tax concessions meant that you didn't have to pay any taxes on debentures. This was done to develop the debenture market, right? And 2013, okay, sorry. So one of the debentures that came out, Alliance Finance came out with a debenture. They gave investors options. Do you want coupons monthly, quarterly, semi-annual, annual? Right? You gave investors options. And some people took monthly. And the reason they gave monthly is because their customer base, a lot of people like monthly. It's like a salary type of so you get like a cash flow coming in every month. For some other investors, it's a hassle. They don't want cash flows coming in every month. They would prefer if you get it like semi-annually or annually. Actually, if you think about insurance companies, they prefer zero coupons. A lot of the time for asset liability management, insurance companies, sometimes banks as well, but mainly insurance companies, prefer zero coupon bonds because it's very easy for them to manage their portfolios. So the type of investor and the frequency of their income requirements also plays a part in the type of coupon that you will choose. And then in terms of what you said, the other thing was your effective rate. So that was what I was trying to show you. I don't know if this will show you correctly, but let's see. Try to find that. So it's not here. The debenture issue 2013 is not here. But look, from this debenture, right? This is the Ceylon Bank debenture that was issued last year. Ceylon Bank, Basel III compliant debenture, issued in 2023. Offered investors these two options. Which option would you prefer to invest in? Given your view of interest rates, what are some things that you might consider? Yeah, AER is given here. What are, which one would you like to have invested in?
Type A because the AER is higher.
Okay, type A because the AER is higher. Any other answers? Not incorrect. That's correct. What, any other answers?
Also A because the rates are going down.
And how does that impact you?
Because as you go along, if you get it quarterly, you will have to reinvest it at a lower rate.
Right. So, yes, that's another thing that you might want to consider, right? So, here the AER is 28. Let me just put that into a. So, you have an annual and a quarterly debenture that has been offered to you. Which one would you prefer to invest in? Let me change the numbers a little bit. And let's say it has been given to you 28% annual, right? Where the AER is also 28%. And quarterly rate that was given in the debenture was 25, but let's say it's 25.5, which comes to the same AER of 28%. This is slightly higher, 28.04, right? Which debenture would you prefer to invest in? Now, the person who said because the AER is higher, now which debenture would you prefer to invest in? Same company, so same risk, same, everything is the same.
Now it will
Okay.
depend on my preference between receiving it annually versus quarterly.
So which one would you prefer though?
Quarterly, madam.
Quarterly because?
AER is same. We can generate cash flows more frequent.
Okay. Yes, AER is same. You can get cash flows more frequently. But remember here, the problem here, right? And this comes up only in certain situations. But the problem in this is you're looking at AER in this high interest rate environment. What does AER mean? AER means that you are going to go and reinvest these cash flows. At what rate?
Higher,
Sorry,
at a higher rate.
at the same rate, at AER itself, right? So if we take 25.5, you're getting a cash flow of 6.375 every quarter. This 6.375 that you get this quarter, you have to go and reinvest to get a 28% AER at something that's going to give you that 28%. Now, in this interest rate environment where interest rates are coming down, will you ever find anything that will give you this 28%? No, right? So that's the problem with this. I mean, annual, there's nothing more that you can do. Ideally, if I had a zero coupon at 28, I would love it. That way, I know there is no reinvestment risk. But here I have reinvestment risk. So this quarterly coupon bond, although theoretically your answer is perfectly correct, you're either agnostic between investing in either of these, or because this is slightly higher, you would prefer quarterly, right? But practically, here you'll see that 25.5% quarterly doesn't translate to 28% AER. Because interest rates are coming down, when you get the interest, the 6.375 interest, now the new rate that you will be reinvesting it at will be lower than 28%. And when you get the next interest, the new rate that you will be investing it at will be lower than 28%. Much lower than 28%. So from the time that bond was issued to today, interest rates have come down by more than 10%. The AER is never going to be 28%, although it shows higher. So that's something practically that you should think about when you're investing in these high interest rate environments. When you're taking into account these high interest rate environments, practically AER doesn't make sense. Theoretically, yes, AER is what you should look at. But those are mostly for stable interest rate environments, right? When you have fluctuations like Sri Lanka, AER sometimes doesn't give you proper results. Any questions? Okay.
Miss, so basically the reinvestment risk is higher when frequency of coupon payments are higher, no?
Over a 1 year period, right? Over the 5-year period, actually it can go either way. Getting coupons more, getting coupons less can go either way because it depends on the timing of the coupon and where you get it. No? So, but over a 1 year period, when you're comparing within that 1 year, how do you get your cash flows? Do you get it 4 times a year or do you get it 1 time a year? Then yes, reinvestment risk is higher for the shorter term. For the
You said it depends because interest rate environment can change.
yes, because let's say, for example, over the 5-year period, if interest rates move like this,
Okay.
right? So then you can't exactly, that comparability becomes a bit of a problem. But at 28%, if you don't think that rates will come back again to 28%, then certainly the 1 year is much better.
Right. Thank you.
Okay, so a few other features. So now what we talked about, maturity and coupon, were common to both debentures as well as treasury bonds. All of these things that we're talking about from here onwards are only there for debentures, right? Not for treasury bonds. So some debentures can be secured, some can be unsecured. We talked about this in the morning. Unsecured means no security has been given to you. Secured means there has been some collateral that has been given to you. Okay. So debentures can be unsecured or it can be secured. Most debentures are unsecured. Most debentures are unsecured, right? No security is given to you. Very few debentures in the market you will see secured. So sometimes when you talk about the definition of debentures, we talk about it from the point of it is unsecured. And then that's why we refer to secured debentures separately and say this is a secured debenture, right? Now, when you think about a unsecured debenture, when you think about an unsecured debenture, as an investor, what do you have to evaluate? What do you have to evaluate?
Cash flows.
The credit quality of the company, right? You have to evaluate the credit quality of the company's ability to pay you back. But if you think about a secured debenture, what should you evaluate? I mean,
The
you do
security.
the security, exactly. You don't want the company to default, so you should evaluate the company as well. But you also have to make sure that you evaluate the security that's given, the validity of the security that's been given, right? So if you remember, this is not about debentures, but the global financial crisis, it started with part of the reason for the global financial crisis comes with security that has been given, right? So there it was about trust papers, or essentially what different types of securitizations. And there you had a lot of these instruments that security was given in terms of mortgages, right? Housing loans with collateral housing. And what happened during the global financial crisis, all these houses started to default. People started to keep on selling. It was a buyer's market and house prices crashed so much that it was not enough to recover. Like the prices crashed so much, the security crashed so much that you couldn't recover the loans. So the credit quality of the collateral, or the quality of the collateral, not the credit quality, the quality of the collateral is very important when you're thinking about a secured debenture. Okay. Can the collateral, in case of a problem, pay you back? Guaranteed debentures? What do you mean by guaranteed debentures?
Someone else is guaranteeing payments.
That's right. In case the company defaults, you're guaranteed by a third party, right? Usually, this third party in most countries would be your parent company. In Sri Lanka, we have kind of restricted that. We used to have the ability to have guaranteed debentures with your parent company, right? But the new rules since 2014, I want to say, the new rules say that the debenture must be guaranteed by a bank with minimum rating of A minus. So if you want to go for a guaranteed debenture, it should be guaranteed by a bank with a minimum A minus rating. Those days we used to have debentures like, for example, Ace Power. If you all have heard of Ace Power, Amelipitia is a power plant, right? Part of the Aitken Spence group. So you had a Ace Power debenture long time back that was guaranteed by Aitken Spence. Like this, you had all these different debentures that can be guaranteed by the parent, by the associate company. But now, according to the new CSC rules, guarantees must be from a bank rated A minus and above. But the good thing is these debentures, in case the company fails, the bank will pay. So in a guaranteed debenture, what are the things that as an investor you should think about? As an investor, what are the things that you should think about?
Whether the guarantor can honor the guarantee.
Yes, the quality of the guarantee completely. The guarantor's financial stability and the quality of the guarantee that has been given, right? So, for example, when you have the parent coming in as the guarantor, you can have so many problems because the parent sometimes can be less stable than the subsidiary company. Not in the case of Aid Constraints, of course, but you can have. For example, this is not a listed debenture, but you have had corporate debt or loans that have been issued guaranteed by parents on the unlisted space. And, companies like Vanik, when they crashed, you would see that you're guaranteed by your sister companies, by your parents. And when one crashes, a lot of these cross clauses become a problem for you, right? So the ability of the guarantor to pay you back, the financial stability of the guarantor becomes very important. CSC, with their new rules, has taken out that problem because now the guarantee has to come from like a bank, right? A- and above financial institution. So that kind of gives you much better safety with regards to a guarantee, with regards to a guarantor. But you also have to evaluate what is the guarantee terms. What are the guarantee terms? For example, it doesn't mean just because you are guaranteed that 100% of the debenture will be paid back. Sometimes only 50% of the capital is guaranteed. Sometimes coupon payments are not guaranteed. Okay? So you have to read the guarantee. Just because the debenture says guaranteed debenture doesn't mean everything is guaranteed by. So for you as an investor, buyer beware. You have to read the clauses. You have to see what has been guaranteed. Okay. And it could be that only 50% of the capital has been guaranteed or no coupons have been guaranteed, right? So these are things that as an investor, you should be careful about. Subordinated versus unsubordinated debentures. What this means, subordinated, means essentially, I always keep saying this in every class, think of a subordinate in your company. Who do you call a subordinate? A subordinate is a person that's under you, right? A person that reports to you, a subordinate. So, what is a subordinated debenture? A subordinated debenture is, in case of a bankruptcy, a debenture that ranks below other debentures in terms of repayment. Right? So, in case of bankruptcy, you will rank all the debentures. So, now we spoke about certain things. We spoke about secured debentures, unsecured debentures, guaranteed debentures, subordinated debentures, right? Like unsubordinated debentures we haven't spoken about yet. Right. Of these types of different debentures that are there, which debentures do you think are the most safe debentures?
Secured
See.
debentures.
Secured debentures? Are the answers? That's it?
Subordinated debentures.
Most safe, right? Most safe. Subordinated debentures, in case of bankruptcy, we get paid after every other debenture holder. So they are not as safe. But between guaranteed and secured, what are your thoughts?
Guaranteed is safer.
Yeah. So again, this is up for debate, right? I will always take guaranteed. This is up for debate. This, I won't say secured is safer, guaranteed is safer. Depends on the type of security that has been provided and the type of guarantor. Guaranteed is a third party. In case the company fails, you don't have to depend anything on the company. As long as the guarantor is creditworthy, the guarantee terms are good, then this is a better option because somebody else is paying, right? So I would put guaranteed debentures first, but you can put secured first. Nobody's going to ask you for a ranking. That depends on the terms. Secured depends on the type of security that has been provided. Let's say, for example, you have 2 billion worth of debenture holders and you have been given a plot of land as security. debenture fails, company goes bankrupt, you can sell that plot of land. If you recover 3 billion from that sale of land, all secured debenture holders will get paid off, right? And that 1 billion left over will go to the unsecured pool. 2 billion, of 3 billion will get paid to the secured debenture holders, and then the rest will go to the unsecured pool to pay off the unsecured debenture holders. But if you sell the land and you only recover 1 billion, then what happens? Out of 2 billion, only 1 billion worth of money will get paid out to the secured debenture holders. After that, they become unsecured. So you have to sell off other assets in the company and look at what you can recover. So the quality of the security becomes very important for you to assess before giving anything to the company. Right? After you, so guarantor, you don't have to worry about it. You go to the third party, ask them to pay. Secured, you sell off the asset that has been given to you as security and you recover the money. If there is more money, it will go to the unsecured creditors. Right? Now, the unsecured creditors will start selling off the rest of the things in the company. Right? The tables, chairs, whatever, they'll start selling off everything else in the company, the stock in trade, whatever. And they'll recover their money. Right? If there is money left over after secured, unsecured debenture holders have been paid off, then subordinated debenture holders will be paid. Then, right? So subordinated debenture holders come below all other, not just debenture holders, all other creditors. You are subordinated. You are sub to the others, right? So this is higher risk. Higher risk doesn't mean you shouldn't invest. Higher risk means that you should check you're getting a higher return. If you're being given the same return as the other normal creditor, you're not being compensated for the risk that you're taking, right? So as investors, this is what you should be checking for. Unsubordinated simply means you are not subordinated. So unsubordinated and unsecured fall in the same category. Sometimes we call it senior. Senior doesn't mean higher. Senior simply means not subordinated, right? Unsecured, unsubordinated, senior, all of these generally fall in the same category. Any questions?
So like when it comes to this risk level of risk and all, ma'am, like when there is a debenture issue, you as investment bankers price accordingly, right? With the risk and return.
So see, investment bankers will always work with the company, right?
Yeah.
Investment bankers are being paid by the company to make sure to
They
try to get the best rates for the company. Yeah.
Yes, correct. Yes.
They will negotiate with the investors on behalf of the company. Obviously, they want the investors. They are not going to try to look like how do you say, take advantage of investors, because ultimately you have to work with these investors going forward as well. But they're still working for the company. They're still getting paid by the company, right? So it's up to you to negotiate the rates according to the risk. They are not your best friend, no matter what, right?
Right. Okay.
Miss, this ordering, can you just explain that again, please?
The order?
Yeah.
Okay. So the remember, guaranteed and secured, this can be one or this can be two. This can be one or this can be two. There is no hard and fast rule to say that this is one and this is two, right? But guaranteed and secured are basically the lowest risk type of debentures that you will have. Because if the company defaults, if they go bankrupt or they default, in a guaranteed debenture, you can go to the third party and ask for your money back. So as long as the third party is credible and financially secure and stable, you get your money back, right? That's why I generally like to put guaranteed as number one, especially now that according to the CSC rules, guaranteed means that it has to be guaranteed by a bank rated A- and above, which is pretty stable, right? So,
Guarantee
but
in the
there is
sense
no...
that, who is going to give the guarantee? I mean, now you can claim for a third party, no? What kind of third parties you are referring, ma'am?
Banks will give guarantees. They will charge you fees, and the fees will be very high. So the cost of the debenture to the company through the issuer will be very high. But they will give guarantees.
When issuing the debentures, when debenture issuance is
Yes.
the bank will give a guarantee.
Guarantee. The bank
Yeah.
can give a guarantee. You have to ask,
Yeah.
the issuer has to ask for the guarantee, and then they will define the debenture as a guaranteed debenture. Every single debenture is not a guaranteed debenture.
Right.
Very few debentures are guaranteed debentures because the cost is very high to the issuer when you take a guarantee. And then secured debentures again can be one or two, ranked one or two, because the security has been given. In case the company defaults, you can sell that security and recover your money. As long as the security is greater than what the money that has to be paid to you, secured debenture holders are okay. But in case the security is not enough to pay back the secured debenture holders, then they fall into the unsecured pool. That's why I rank it 2.
And
But-
when it comes to the guaranteed debentures also, ma'am, we will have to take into account like whether the total debenture is covered through the guarantee or like
Or
whether,
not.
as you said, the coupons
Completely.
and everything.
Yes. So in case the total debenture is not covered by the guarantee, only 60% is covered by the guarantee, then 40% you become unsecured. 60% of your money will be paid back, but for the other 40%, you have to wait with the other creditors to recover your money.
Yeah, okay. Thanks.
So unsecured creditors are everybody. Everybody who doesn't have a status essentially are unsecured creditors. Unsecured creditors, unsubordinated creditors, senior creditors, everybody falls into the same status, right? And finally, after all these creditors are paid, only subordinated creditors will get paid. If
So
there is money
subordinated
left,
is the last in line.
subordinated is the last in line. That's why it is sub, below you, right? It is subordinated. So they get paid only if there is money left after everybody else, all other creditors get paid. Who are below subordinated creditors?
Bonus.
Owners, shareholders, right? If after subordinated creditors get paid, there is money left over, then the owners will get paid. Shareholders will get paid. But I mean, then why go bankrupt, right? If there's so much money left, there's no reason for you to go bankrupt and default, right? So
Correct.
subordinated creditors have higher risk. So let's look at a few examples. So for this particular debenture that we just looked at, I'll come back to it when we do convertibility, right? So I won't look at that right now. Let's look at. I think because it's. Not coming up. Something's wrong. Just give me a minute. You all might get cut off. I'm going to change the Wi-Fi. Give me a minute, please. Let me try again. Okay. I hope you all are still here. Nobody got cut off, right?
No, ma'am.
Okay. All the debentures have matured. Okay. So you see here commercial credit, right? Who did a debenture in 2015. And it says here, issue of 10 million rated guaranteed capital and 2 installments guaranteed subordinated redeemable 5-year debenture, right? So this is guaranteed. If there is anything else left to be paid, it is subordinated debenture. Technically, it doesn't make sense because the entire capital has been guaranteed. But here you see, with the guarantee, now it has been guaranteed by HNB and Sampath, right? HNB and Sampath Bank have guaranteed the payments of the debenture, principal sum, and 2 interest installments in equal proportions in the following manner. So 50% guaranteed by HNB and 50% guaranteed by Sampath Bank, right? So that gives you an idea of the debenture. And here you can see the company rating is BBB. Issue rating is A+. What does that mean? If you know ratings essentially start from a maximum of, so it's like credit ratings are like A, B, C, D rated ratings, right? So A is better than B, better than C, better than D, right? And within A also you have categorizations, 3 A's, 2 A's, 1 A, triple A, double A, single A, right? And then also you can have A plus, A minus, double A plus, double A minus. So this company, this issue means the debenture is rated A plus. The company's commercial credit is rated BBB. Why? What is happening here?
Guaranteed.
Yeah, it's guaranteed. Exactly. So the company is rated BBB, right? Meaning it's not a ECA investment grade company. But to get better rates, what the company has done is they've got themselves guaranteed. Okay. And with that guarantee by HNB and Sampath, what has happened? The debenture is now more secure than directly borrowing from the company. The company has a rating of BBB, which says in case you borrow from the company, this is the ability of the company to pay you back. Because this debenture is guaranteed by Sampath and HNB, you can see it is more secure. And therefore, the issue rating, the debentures rating is A+, higher. Okay, let's look at another one. Asia Asset Finance, did a debenture. Right. Secured debenture. So Asia Asset Finance in 2021 did a secured debenture, secured asset-backed, listed redeemable 3-year and 5-year debenture. 5 billion going up to 10 billion. Oh, sorry, 1 billion. So 500 million to a billion rupee debenture. Again, you see this is a secured debenture, secured debenture. Look at the security that has been given. Security. Security provided by the company in favor of the trustees for the benefit of the debenture holders. It's a mortgage bond that pledges the entire future gold loan portfolio from 1st of July 2021. So the gold loan portfolio of Asia Asset Finance, commencing from 1st July 2021, based on certain criteria, has been pledged as security in the debenture. Okay. So that's the security that has been provided. You can see here, shall rank in priority to all other unsecured creditors and the rights and preference of any ordinary shareholders. That's the security that has been provided. And because of this security that has been provided, you can see again, issuer's rating is BBB plus, issue rating is A minus. Issue rating is higher because of the security that has been provided. So soft logic, I was trying to show you all, but like the debentures have matured and they've taken the prospectus out of circulation. But soft logic did a debenture which was guaranteed by DEGFMO, right? That's multilateral agencies. And because of that guarantee by multilateral agencies, they got a AAA rating, right? So soft logic again had triple B or something rating. And because of its multilateral guarantee, SoftLogic Finance, they got a AAA rating on the debenture. AAA is the highest credit quality rating that you can get because the debenture was guaranteed by FMODG. So you see here, Alliance Finance. I chose this debenture to show you the other thing that I was talking about as well. Here, Alliance has issued a subordinated debenture, subordinated, listed, rated, unsecured, redeemable 3, 4, 5-year debentures, right? So subordinated means you rank below other creditors of the company. So here you have these different debentures that have been issued, and you can see where is that? Interest rates, right? So you have 3-year, 4-year, 5-year debentures that have been issued, payable semi-annually, and you have a zero coupon. So these are fixed rate coupons and then a zero coupon debenture. And you can see of this zero coupon debenture, fixed rate coupon debentures have all been issued at 100 rupees each. Zero coupon debenture issued at 46 rupees. There's no coupons, right? No coupons. It depends on how much you pay at the beginning of the period. Okay. So this is commercial bank 2016, unsecured subordinated redeemable debenture, right? They did a 7 billion debenture 2016. It's subordinated. And here you can see the issuer, which is commercial bank, is a double A rated company, right? Issuer is commercial bank. It is double A rated. Issue, which is the debenture, is double A minus rated. Why is that? Issue is double A minus rated. Double A minus is worse than double A or better than double A?
Was
It's worse because it's subordinated. Exactly. So commercial, if you just go to the company and borrow on unsecured basis, is rated double A. That's the credit strength. But if you wait for subordination, because you get paid after all other creditors, you are slightly worse off. You can see that double A minus is not too bad, right? You're slightly worse off. But you can see that subordination increases your risk. So these are some examples of different debentures that we have. Now, banks issue Basel III compliant debentures, but Basel III compliant debentures, I'll talk to you when we do the convertibility part. I don't want to look at that right here, right now. Any questions? Right. Definitely. So what we have now is what we call contingent convertible debentures. That's there in your that's there in your notes. So right. So it's just a few slides away. Only thing is we won't have time to do it today. So when we do that, I'll talk to you about those debentures, which is what we call Basel III debentures in Sri Lanka. We'll come to it. So I'll stop at this point, right? Because we've come to a good point to otherwise to talk about callable bonds might take a little bit more time. So next week, I'm not going to talk about callable bonds. We're going to look at bond valuation, and we're going to jump here just for convenience, bond markets in Sri Lanka for next week. We'll do bond markets in Sri Lanka, do bond valuation, start bond valuation, and finish that bond valuation section, and then come back to this, right? So we're going to put a pin in the first part of this set of slides for next week. And for next week also, can I request that we have 2 classes on site? I'm just asking. You all can tell me no, that's okay. Because it's a valuation class, it might be better that you all do both classes on site. Then you kind of finish that component. But up to you all.
I have planned my board meeting on next Saturday. So I'll be there with the board. Doesn't might be enough.
Okay. So okay.
Miss, just to give some context, I think we were told that the physical class will be last weekend of every month. I think that's why.
Yeah, I think you all had requested though not to have the class this week physically because of.
No, we have requested to have it on physically. What happened was they have had classes on Saturday and Sunday both. We said, let's postpone the Sunday online class because we had planned other works because it should be on Saturday. So we said, let's have the Saturday on-site class, but they have cancelled and made it an online class.
Okay. No, they cancelled actually on my request because we were not having it tomorrow, and then they were talking about how because of the long weekend some couldn't attend. I said if we can shift it, let's shift it to next week. So that's okay. We can. So yeah, I think it would have been a miscommunication. So
Miss, is there any chance we can do the whatever this physical class requirement in the last week of March?
last week of March, okay, the problem is, I mean, that's not a problem. It's just that we'll miss the valuation parts. We'll be doing online. So I just wanted to time the valuation part to the. We can still do next week anyway. This same section we can continue without doing valuations. If we're doing it online, we can continue as we are, and then we'll see how the valuation comes. And if we give like a 1 week notice, is it possible to do a physical? I would think that it's better for you all to do the valuation physical.
Yeah.
Yeah. Even earlier than last week of March, we can do it if we were given like a week or so.
Okay, so let's do that. So we'll continue this. And when we're coming to the end of this section, that week, let's talk about physical class the week after.
Okay.
Okay.
And small request, ma'am, that when you're having two classes, is it possible for you to have it in one single day without having physical classes in 2 days? Getting
I'm okay with that. That's
lectures.
not a problem. I mean, you can talk to Dr. Mahinder about that. That's not a problem for me. I can do morning and evening kind of thing, right?
Yeah.
It's okay. So just that you can ask Dr. Mahinder. I'll also let him know that I'm okay with it. That's fine. Yeah, so let's stop there and we'll continue next week. Thank you.
Thank you.
Thank you, ma'am.
Thank you, madam.
Thank you, madam.
Thank you. Yeah.
Ma'am.
Okay.